You've heard the terms thrown around, right? ETFs, mutual funds, index funds. It can feel like you're trying to crack some kind of secret code. Well, guess what? Today, we are cracking that code. We're going to demystify your dollars and break this whole world of investment funds down into simple, easy to understand pieces. So, you ready to dive in? Let's do it.
So here's the game plan for today. First, we're going to cover the absolute basics, like what even is a fund. Then we'll get into the two main strategies. You've got the passive, kind of set it and forget it approach, and then the active, let's try to beat the market approach. And to wrap it all up, we'll have a little showdown to help you figure out which one might fit your style.
Okay, let's start at square one. Section 1, Investing 101. Before we can get into all the different types of funds out there, we've got to answer a really basic question. What exactly is a fund?
Okay, think of it like this. Imagine you and your friends want to throw a massive birthday party. If you try to pay for it all yourself, you might get some chips and a playlist. But what if everyone chips in? Suddenly, with that big, pooled budget, you can get the giant cake, the cool decorations, the DJ, the whole shebang. Well, an investment fund is pretty much the exact same idea. It's just a big pool of money from a ton of different people, all put together to invest in a whole bunch of different things, like stocks or bonds. It's literally teamwork for your money.
All right, now that we know what a fund is, let's talk about the two main ways to actually manage them. And we're going to start with probably the most popular one, especially for beginners. This is the passive approach. You can think of it as the set it and forget it strategy.
So what does passive even mean here? Well, the key thing to get is that it's not trying to be clever. You don't have some Wall Street genius in a fancy suit trying to pick the next Amazon. Nope. Instead, the fund just copies a list of companies, a market index. The whole goal is just to match the market's performance, not to try and beat it. Simple as that.
And the absolute poster child for this whole passive investing world, it's the index fund. I'm sure you've heard people say it, right? Oh, just put your money in an index fund and forget about it. But what index are they actually talking about?
Well, an index is really just a list. It's a shopping list that represents a slice of the stock market. You've got the famous ones like the S&P 500. That's a list of 500 of the biggest companies in the US. Then there's the NASDAQ, which is packed with all the big tech companies like Apple and Amazon. Or the Dow Jones, which tracks 30 huge established industrial companies. So when we buy a fund that tracks one of these, you're not just buying one company, you're getting a tiny little piece of all of them.
And here is the absolute best part about this simple copycat strategy. Because you're not paying a high-powered manager to make all these decisions, the fees are, well, they're dirt cheap. We're talking ridiculously low, like as little as 20 cents a year for every $1,000 you put in. I mean, seriously, that's less than a gumball. It's pretty amazing.
Okay, so now let's meet the index fund's very close cousin, the ETF, which stands for Exchange Traded Fund. Now, a lot of ETFs are also passive. They track the same indexes, but there's one really important difference you need to know. See, a traditional index fund, it only gets priced and traded once a day after the market is closed. But an ETF, it trades all day long on the stock exchange, just like a regular stock. So you can buy or sell it anytime the market is open, which gives you a lot more flexibility.
All right, so that's the passive world in a nutshell. But maybe you're thinking, matching the market is fine, but I want to beat the market. Well, if that's you, then you're ready to talk about the total opposite strategy, the active approach.
And active management is exactly what it sounds like. It's the polar opposite of passive. In this world, you do have that professional fund manager, maybe even a whole team of them. And their entire job, day in and day out, is to do the research, run the numbers, and handpick the investments they think are going to knock it out of the park and outperform a benchmark like the S&P 500.
So what's the most common way for everyday investors to do this? Well, that would be the classic mutual fund. They've been around forever, and the big selling point is you get access to a pro's expertise. But, as you can probably guess, that expertise doesn't come for free.
And wow, this chart really shows you what I mean. Remember that dollar, maybe even less, you'd pay for a passive fund for every $1,000 invested? Well, for an active mutual fund, you could be paying $10, 10 times more. That's what pays for the manager's salary, their research, all of it. And here's the real kicker. Study after study has shown that over the long term, the vast majority of these highly paid managers, well, they actually fail to beat the simple, cheap index funds they're trying to outperform. Kind of crazy, right? But, okay, if mutual funds are like a race car trying to win, then hedge funds, well, they're like a rocket ship. These are a whole different beast entirely. We're moving into another league now. Yeah, hedge funds are definitely not for your average investor. These are private, exclusive clubs for really wealthy people, what they call accredited investors. And they use some seriously aggressive and complicated strategies. We're talking about borrowing massive amounts of money to invest more, or even betting that a stock's price will fall. It's all about chasing those huge, massive returns. The potential to win big is there, for sure, but so is the risk of losing absolutely everything.
And the fees? Oh, the fees are on a whole other planet. Hedge funds are famous for what's called the 2 and 20 fee structure. So here's what that means. They charge you a flat 2% of your total money every single year just for managing it. And then on top of that, they take a 20% cut of any profits they make for you. It is a very, very high stakes and very expensive game to play. Phew, okay, we have covered a ton of ground. We've talked passive, active, low cost, high risk, the whole spectrum. So for our last section, let's put it all together. Let's do a final showdown, a head-to-head comparison so you can see everything side by side.
And this table just lays it all out perfectly. You've got your index funds and ETFs over on the passive side, perfect for long-term, hands-off investors who want low costs. The trade-off? You're never going to beat the market. You're just going to be the market. Then you jump over to the active side. You've got mutual funds where you're paying for a manager's strategy, but you're also paying higher fees for what is often underperformance. And finally, you have the hedge funds, the wild card, with the potential for those massive returns, but really only for wealthy folks who can handle the crazy risk and the eye-watering fees. Look, if you're still sitting there thinking, okay, but where do I even start? It's pretty hard to argue with the man himself, Warren Buffett. He's been saying it for years. For the great majority of investors out there, a simple, low-cost index fund is the most sensible way to go for building wealth over the long haul. Can't get much clearer than that.
So there you have it, the whole playbook, from the slow and steady index fund all the way up to the high-flying hedge fund. You've got the map now. The only real question left is, what's your next move?